Hello people, you're welcome once again to our YouTube channel. Today I want to share with you how to get entry confirmations while trading supply and demand zones. How to get entry confirmations while trading supply and demand zones, or even smart money concepts. All right, so I want to thank you so much, my returning subscribers, for subscribing, for coming back to view our videos, for liking our videos, sending our videos to your friends, sharing our videos. And if you're a new subscriber, I want to thank you so much as well for stopping by. I want to ask also that you kindly please subscribe to this channel and also turn on the notification bell so that you can be alerted when I post new videos. I share new contents weekly. Also, you might want to join our free Telegram channel. The channel is where I post chart analysis, setups, and chart analysis almost every day. The link to that Telegram channel is in the description box of this video or the profile section of this YouTube channel. So you see that in that Telegram channel, I usually share free setups, and those setups you need to get entry confirmations in order to trade those setups profitably. So let us go straight into the video. We are talking about how to get entry confirmations while trading supply and demand zones, or even smart money concepts. Okay, how to get entry confirmations while trading supply and demand zones or smart money concepts. Now, there are actually two ways you can actually get into a trade when you are trading supply and demand zone. But for example, let's explain what supply zone actually are. Actually, this is a supply zone, is a zone from which we sell. All right, you have like this. You have like this. Let's have a clearer view. Okay, so a supply zone, this could be a supply zone. So we expect that when market comes back to that zone, it's going to sell. All right, so this is a supply zone. A supply zone is a zone from which we expect the market to sell from. Okay, or we call it smart money concept traders, or the smart money concept traders, or the ICT traders. They also call it bearish order blocks. Okay, they call it bearish order blocks. Now, this is a supply zone. A supply zone. Okay, now let us see a demand zone. A demand zone is like this. Oh, let's have a like this. Okay, and the market bought up, so we are expecting that when price comes back to the zone right here, that the market is going to reverse to buy. So this is our demand zone. The demand zone is a zone from which we expect that when price comes back to, it would buy. So demand or buy zone. Okay, so this is a demand zone or a buy zone. All right, so what is the purpose of this video today is to explain to you how you can ensure that you get an entry confirmation while trading supply and demand zones. Now, it is not all the time. It's not all the time that when price comes to a demand zone that is going to buy, and it's not all the time that when price comes to a supply zone that is going to sell. You can have a situation whereby a price can come to a demand zone or a supply zone and blast through the zone. If we have a supply zone like this, if we have a supply zone like this, okay, you may expect price to come and actually sell, but price can sometimes blast through the zone instead of selling. All right, you can also have a demand zone in this fashion. You might expect that this is a demand zone. You might expect that price would come back and buy, but you can sometimes price would actually blast through the zone. So, and you might lose money when this happen. So what are the ways? There are two ways most demand and supply zone traders trade. There are two entry types. The first entry type, there are two entry types or two entry methods of trading demand and supply zone. Two ways you can enter. Okay, the first one is the limit entry or risk entry. Okay, while the second one is confirmation entry. Okay, the second one is called the confirmation entry. The first one, which is the limit entry, as I have said in my previous video, it was popularized by a man called, an American man called Sam Dearden. Okay, Sam Dearden, I think I'm correct with this spelling. So it was popularized by, he was a broker, and he popularized the limit entry method. The limit entry method depicts a situation whereby you identify a particular supply or demand zone, and you place a limit order, a sell limit order, a buy limit order, so that when price comes to that zone, your limit order will be activated and in the direction you intend it to go, and you place your stop loss right above the zone or below the zone. Let me explain it clearer to you. The limit entry method is also called the limit entry method. The limit entry method is also called the risk entry method. Okay, so how does this play out? Now you identify, like, this is a supply zone right here. So let's draw it clearly. This is a supply zone right here. So for a limit entry method, you would just place your sell limit order here and place your stop loss right here, and you expect that when price comes, it's going to sell down. Okay, that is a limit entry method, but sometimes this method is not very reliable, because it works sometimes because you did not actually get any confirmation as to when price comes to the zone. Several times we have had cases whereby price can come to that zone, instead it will activate your sell order and continue to buy and hit your stop loss instead of selling down. So that is why recent traders, which are the modern traders would rather wait for price to come to the zone and see some signs of buying if it were in a demand zone, or some signs of selling if it were in a supply zone, before they now manually get into the trade. Let's see, like for example here, this is a supply zone. You can see this is a supply zone right here. There's a supply zone right here. You can actually see that if you had placed your limit or your sell limit order right here, it would have been, and your stop loss right above here, it would have been activated, and your stop loss would have been hit. There was a stop loss rate right here. So you wanted the price. Well, limit order traders would have loved that price comes to this zone, activate this limit order and sell. But you can see that price actually took out stop losses right here, and rather respected the zone above, respected the supply zone above instead of this one, and sold. You see? So, but if you were to use the second method, which is the confirmation entry method, you would have seen that when price came to this zone, there was no sign of sell right here. So you would have actually not get into the trade in order not to lose your money. So that is why the confirmation entry method is better. The confirmation entry method is better. Like, for example, you can see here as well, this is a demand zone. This is a demand zone right here. A limit entry order trader would have placed a buy limit order right here, but you can see that the price came to the zone, and instead of buying, it actually continued to sell, and stop losses that was placed right here would have been hit at this point. So that is why, that is the limitation of the limit entry order method. And you know, the limit entry order method is also called the set and forget strategy. Okay, it's called the set and forget strategy, whereby you place your stop loss, you place your limit order, buy limit or sell limit, and you go and sleep, expecting that price will hit your limit order and sell or buy as the case might be. So now let us go into the modern and the current strategy, modern and current more reliable entry methodology, which is the confirmation entry method. So the second way of trading entering a supply and demand zone trading is called the confirmation entry. Okay, it's called the confirmation entry method. All right, it's called the confirmation entry method. So what does the confirmation entry method imply? We use the principle of structure. We use the principle of structure to determine when price is about to reverse. I've made a video on structure, market structure. Try to do well to view that video, because it will help you to understand the limit entry method better. Okay, so we have determined that the forex market moves in accordance to structure. Market creates a higher high, higher low, higher high, higher low, higher high, higher low. Okay, higher high and higher low. All right, so now we have the market sell down, and when it's sold down, it would have given us a supply zone right here. So instead of placing a limit order right here, we wait for price to come to the zone, and when price comes to the zone, price is creating higher highs and higher lows, comes to the zone, we want to see a break of structure. The market creates higher highs and higher lows. Okay, we want to see a break of structure that shows that the market is about to sell, and that break of structure, we call it a break of structure that triggers a change in market direction. We call it the change of character. I've made a separate video on change of character. A change of character. So when this happens, when there's a change of character, which is actually depicted by a break in market structure at a demand or supply zone, we know that the market have given us some signal to buy, to sell, or to buy. We now wait for what is called the return to order block, for market to come back to the zone in order to now get into the trade and sell. So this is for a sell scenario. This is for a sell scenario. Okay, so we identify a supply zone, and we wait for price to come to the zone and break structure. All right, this is a break of structure in the sense that the market was creating higher highs and higher lows, and at this point a low was broken. Since the market did not create a new high, a low was actually, the previous low was broken, which depicted that the market is about to reverse from a buy scenario to a sell scenario. So that is the principle of change of structure. This is the principle of this is a sell scenario of a confirmation entry. Now let us look at the buy scenario of a confirmation, and I'm going to show you on the chart. After this, I'm going to show you on the chart. Now let's just stay with me. Now a buy scenario of the confirmation entry is like this. The market creates a higher high and higher low. All right, sorry, the lower high and lower low, lower high and lower low. All right, and now the market buys up, giving us a demand zone right here. Okay, and now we want price to come back to the zone. You know, the market does not move in a straight line. The market moves in form of a zigzag, or like the market has an impulse and resting stage. So now the market comes back to the zone, and we want to see some sort of break of structure to the upside. You can see a break of structure to the upside when the market have come to the zone. A break of structure to the upside, which is now what you call, this is a bullish change of character. Very important. So when you have got a bullish change of character, you now wait for price to come back to the zone, which we now have, which we call the return to order block, and we get into the trade for a buy. All right, so this is the confirmation entry, the bullish scenario of the confirmation entry. All right, so the basis of the confirmation entry is, number one, you wait for price to come to the demand or supply zone. Once the price have come to that zone, you actually look or wait for what? A change of character. And we have said that change of character is a break of structure that occurs at a supply or demand zone. All right, so when there is a change of character, we wait for price to return to the order block that triggered the change of character, and then we get into the trade. All right, so this is the confirmation. That is the confirmation entry. Now another way you can do confirmation entry, this confirmation entry, looking for a change of character and return to order block, or should occur in the lower time frame. Let me show you. Like in this case now, this is a demand zone. This is a demand zone. All right, this is a demand zone right here. This is a demand zone right here. So we can as well step to lower time frame. This is a H1 time frame. We can step to the lower time frame. To be able to, this is the demand zone here. Okay, so we can step to the lower time frame to see if we could see where the break of structure occur, because this break of structure, this change of character and return to order blocks will occur at a lower time frame. All right, it does occur at a lower time frame. So let us go to, this is the H1 time frame. Let us step down to 5 minutes time frame to see if we can actually see that. Okay, you can see this is the zone we just drew. This is the zone. So you can see that there was a break of structure. The market was actually having a lower low and lower high. Okay, coming down to the zone. All right, down to the zone. All right, so the market actually came down to the zone. So this is a lower high, lower low, 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 lower high. You need to know how to depict this. I've done a video on market structure. lower high, lower low, lower high. Now you can see the market came into the zone. This is the zone, all right, that we drew on a higher time frame. The market came right into the zone. So what happened when the market came into the zone? All right, the market bought and broke structure. Look at this zone. This zone was taken out. So when this zone was taken out, we have what is called the change of character occurred right here when this lower high was taken out. This was a break of structure that occurred after the market have made an incident into the point of interest. This is our point of interest. I usually show you. This is our point of interest. I used to show you on the Telegram channel. I would tell you that the market is at our point of interest. Point of interest is at your demand zone, your targeted demand zone, your targeted supply zone. So you can see that the market broke structure, took out this supply zone. And now when the market took out the supply zone, we now wait for the market to come back. Okay, we now wait for the market to come back to the zone that triggered the break of structure. You can see that the market bought up and came back. So this is our entry. You can place your stop loss right here. Instead of having this large stop loss, okay, you can have this small stop loss. So that is what actually, that's the beauty of confirmation entry. It reduces your stop loss, it refines your entry. And when you have a small stop loss, you can be able to have a higher risk to reward ratio. Smaller stop loss would lead to higher risk to reward ratio. This is very, very key, very important. So you can see that we have a small stop. This could be like 2 to 5 pips, not more than 5 pips, while this large stop loss could be up to 20 to 30 or 40 pips. All right, so but this small stop loss could be like maximum 5 pips. Okay, so we have been able to refine our entry. So you can see now when you get into this trade, the market now really bought. Okay, let us actually move to the higher time frame. So you see, this was actually the zone that I just showed you on a small time frame. I showed you on a 5 minutes time frame. That's the zone I showed you on a 5 minutes time frame. You can see it again. You can see the zone. The market broke structure. The market actually broke structure, take out this high, and now return to order block and bought. So this is a confirmation entry. Now I want to show you a buy scenario, a sell scenario of this same principle. All right, let me show you a buy scenario of this same principle. Now you can see for a sell scenario, which I just showed you a buy scenario. For a sell scenario, we have this. You can see that this is a supply zone. This is a supply zone on AUD USD. This is a supply zone right here. Okay, so on this supply zone, we have, this is a supply zone. This is another supply zone that you can also as well use for this same example. This is a supply zone that actually market came to this supply zone and broke structure and sold. All right, but this is another one as well. These zones actually, if you go to lower time frame, because this is a higher time frame, which is 1 hour time frame. If you go to lower time frame, my lower time frame is like 5 minutes or 1 minute, 1 minute time frame. Higher time frame, you are talking about 1 hour, 4 hours, daily time frame. Even sometimes your 15 minutes and 30 minutes could be your higher time frame if you are using your 1 minute time frame as your entry confirmation time frame. All right, mostly I trade the 15 minutes. I get my setups on 15 minutes, 30 minutes, a maximum 1 hour time frame, but mostly 15 minutes time frame. And I actually my setups, I do get my setups in, because I'm a day trader. I'm not a swing trader. I'm a day trader. So I like I like actually closing my trade the same day. All right, set up. I get my setups on 15 minutes, 30 minutes, and sometimes 1 hour time frame. Why my confirmation entry? Confirmation. I get my confirmation on 1 minute or 5 minutes time frame. Okay, so now on this chart, let us go down to the lower time frame on this to actually depict the entry confirmation on this supply zone. All right, so we have two cases here. This was a first zone. You see, price actually came to the zone. You can see price making higher highs and higher lows, higher highs and higher lows, and this was a higher low, higher low, higher low, higher high, higher high, higher low, higher high, higher low, and so forth. So the market actually came to the zone, and there was a break of structure. What's break of structure? This last structure, this last low was taken out. So when this was taken out, it is called the change of character has occurred. So now we place a limit, a sell stop order at the zone. We can place a sell stop order, or we wait for price to come to the zone that triggered the break of structure, all right, or that triggered this change of character. And when price comes to that zone, we are now expected to have price to sell. This is our confirmation entry for the sell scenario. All right, this is the sell scenario confirmation entry. Do you see that this zone was taken out? When this is the zone, this low was taken out when price came to this zone, and as it was taken out, we wait for price to come back into the supply zone that took out the zone. We have a refined stop loss of not more than 5 pips, 2 to 5 pips. This main supply zone would have been perhaps 20 to 40 pips, but now refined down to 2 to 5 pips, and now you could have a good risk to reward ratio. Now let us look at the other zone, the higher zone. You see, we actually depicted two zones. Okay, we depicted two zones. This is another zone. Price actually came to this zone. All right, price came to this zone, broke structure right here, came right back into the demand zone, the supply zone that caused a break of structure, and before it now finally sold. And it's still selling. It's still selling. I believe that when the market opens, it's going to sell. At least it should sell up to this point, at least, before it can reverse or continue to sell. Okay, there was a break of structure right here, and we want price actually came back to the zone that triggered the break of structure, and the market sold. This is lovely. Why is it lovely? Because it gives you a higher risk to reward ratio, and gives you higher risk to reward ratio and higher win rate. Okay, so it gives you a higher win rate. Now I want to show you something, my friends. Now what do I want to show you? Another way you can get entry confirmation is by the use of what you already know. It's called when you see a bullish or bearish engulfing candle at a zone, because at a zone on a higher time frame. Now I've told you now, for a confirmation entry method, you have to look at the lower time frame for your change of character and your return to order block before you get into the trade. This is the confirmation entry method for a lower time frame. But if you don't want to go to a lower time frame, if you don't want to strain your eyes going to a lower time frame, you can, on the higher time frame, you can get entry confirmation on a higher time frame while trading supply and demand zone. And how do you do that? You look for what is called the bullish or bearish engulfing candle at the supply or demand zone. Are you with me? you look for what is called the bullish or bearish engulfing candle at the demand or supply zone. Now let us see what I mean. This is a bullish engulfing candle. When you have buy candles going up, the market is buying up in candles because the market actually buys up in candle. Now you see, this is the zone. This is the zone. All right, the market came to the zone, and when the market is at the zone, you now get what is called the bullish bearish engulfing candle, a candle that takes out the other candle, a red candle that takes out the other candle. This shows you that the market is about to sell. All right, here now you can see these are bullish candles, but here you can see this blue candle, this green candle was taken out by this red. It was taken out by the red, okay. This is this candle, let me expand it. This candle actually took out, can you see this candle, this particular candle took out this candle. All right, this is a bullish, this is a bearish engulfing candle. Okay, it engulfed this candle, engulfed this candle, took out the low of this candle. This signified that the market, even though we are on a higher time frame, it signified that the market is about to sell. So you place your entry at the middle of this candle. Okay, you place your once this candle have been taken out, you place your limit order at the middle of this candle. All right, that shows that the market came back to the middle, or even surpassed the middle, and before it now finally sold. All right, so, and this is our target. The target is the previous low here, the previous low. This is our target, and the market came to the target. Okay, this is a way of getting entry confirmation on a higher time frame without going to a lower time frame. Now let us see the other one. See the other one here. See the other one here. Can you see here? Look at this candle. This is a blue candle or green candle, was taken out by this engulfing candle. And when the market took out this engulfing, candle, you find out that the market sold, and I believe it's going to sell up to this point. So this is a way of confirming, getting entry confirmations. Is a way of getting entry confirmations without going to a lower time frame, by working with only the setup time frame that you have. It's called bullish or bearish engulfing candle. So this is actually it. Now there are two reasons why you need to get entry confirmation. Be patient enough. Why you need to be patient enough to get entry confirmations? I've said it. Number one is it will improve your win rate. Okay, so while in several years ago, most traders, what they know is the limit entry method, as popularized by Sam Dearden. So they just place a limit entry order at a supply or a demand zone at the entrance of the zone, and they put their stop loss at the other side of the zone. All right, and you know what happens? Several times it works sometimes, but sometimes it's actually fail. Most times it fails. All right, so, and they lose money. So that is why the improved limit entry, the confirmation entry method is better, because it helps you to avoid unnecessary losses. When you don't find an entry confirmation at a zone, you don't enter the trade, and hence you would have stopped some losses, and then your win rate will ultimately improve. All right, so now for the second reason why you need to wait for an entry confirmation, or implement the principle of entry confirmation in your sales, in your trade, is that you have what is called, you have higher risks to reward ratio. Okay, higher risk to reward ratio. I actually showed you in that chart. I showed you in that chart, and I said that for a zone, like in this zone that I showed you, this zone I showed you, if you were to let's work with this only, this alone. For this zone I showed you, if we are to work with this zone, put our stop loss right here and our entry right here, stop loss right here, entry right here, this could be nothing less than, this will 20 to 40 pips. Okay, but when you saw that when we did our confirmation entry, we had just this zone, we have our stop loss just here on the lower time frame, and this should not be more than 5 pips. And you see the large risk to reward ratio of more than 3. So mostly when you are trading using a limit entry method, your average stop loss, your average risk to reward ratio should be around 1:2 or 1:3. But when you are trading with a limit entry method, you should be looking at an average risk to reward ratio of around 1:3 to even 1:10. You can have 1:10. Okay, between 1:3, not less than 1:3. If you are doing a limit, or if you are doing a confirmation entry method entry for a demand or supply zone, you should be having a risk to reward ratio of above 1:3, at least 1:3. You have seen traders that have even as high as 1:10, right? But a decent 1:3 is lovely. 1:3 to 1:10, or 1:5 is lovely. All right, so this is it. These are the benefits. These are the benefits of having an entry confirmation while trading the supply and demand zone. All right, so as time goes, I'm going to be bringing you more useful content. But till then, I want to ask that you please kindly subscribe to this channel and share our videos with your friends. If you enjoy this video, kindly please give this video a thumbs up and let me know in the comment section the kind of videos you want me to do for you. All right, it's my desire that you grow and become a better trader. And if you also want to have free setups, chart analysis, you can join our free Telegram channel. The description box is where the link of that Telegram channel is. There I post free useful chart analysis almost every day that you can trade at your own discretion when you get some entry confirmations as I've just showed you now. All right, so till I come your way next time, do have a very wonderful and lovely day ahead. Goodbye.